Papa, can you hear me? Rick Papa Pannone, our Director of Capital Markets. What's up, sir?
What's up?
What's going on, bro?
Good to
All
see
right, so on a scale of 1 to 10, 1 being virtually impossible, 10 being without a doubt, how difficult is it to predict mortgage rates?
It's a 1. It's a 1. It's virtually impossible.
Super.
Yes.
All right, great. But we're going to shed some light. Now, I saw a recent article that I showed you in the Associated Press about, rates ticking down. I know that was probably the more aggressive model, but, why don't you give us an update on what's going on?
Sure. So rates have ticked down. Just to speak to what generally people see. So the 10-year is what seems to be what is the barometer for interest rates or mortgage rates, has ticked down, and just even as of today, we're at a low that we haven't seen since mid-December of last year.
Okay.
So the market's going in the right direction from the Treasury's perspective. Now, as to what's causing this to happen, it's a whole group of things.
Right.
Initially, we saw a spike in yields because of the incoming president and because of the potential impacts of his policies,
Sure.
namely tariffs. That was the concern. And then the impact of tariffs on inflation. And generally, inflation is not a good thing, as well as on the unemployment. But inflation was the primary driver. Since then, we've actually seen that tariffs aren't as big of a concern as originally thought.
Right.
And even with them, being imposed on Mexico, on China, on Canada, the concerns have diminished. We've also had a fair amount of economic data that has been a bit mixed, but also not truly supportive of the economy going in the wrong direction from an inflationary perspective. It's basically pointing to somewhat of a weakening. There's definitely a weakening in the employment space, as well as a little less of a concern on the inflation front. So then you can even look at where energy is. And like just today alone, we're seeing oil trading down. Mm-hmm. And there's definitely a directional relationship with the price of oil and mortgage rates, surprisingly enough. There's been a lot of banter lately from some funds out there where they're definitely seeing cracks in the economy, and they're trading on those cracks where anytime there's some uncertainty in the market, it generally creates a flight to safety, which is the Treasury space. Even Berkshire Hathaway has a sizable position in treasuries right now, and in cash. So there's just so much going on. So it's not like you can put your finger on one thing that's sort of causing the momentum or the positive movement that we're seeing. There's a lot, but saying that it's good for us right now.
Well, I think that's how I want you to comment here at the end is what's the message for buyers? What's the message for homeowners with a lot of equity that are looking to either save money, paying off debt? There's still good things to be done right now.
Oh, there are. If you look at just where debt is, right? So we look at where credit card spending has gone, where I think it's at 1.5 trillion. It's unbelievable how much debt exists in the space right now. So to be able to refinance debt that's at 24% on credit card debt and reduce it, granted you may not want to impact your primary mortgage, but there's second mortgage alternatives that exist. As far as the buyer space goes, definitely rates are trending in the right direction. So There's really no reason to be sitting on the fence right now. There wasn't a reason in the past, but the direction we're going right now, there truly is not a reason.
Awesome. So you can see why our mortgage professionals are so lucky to have this guy in-house. So thank you, buddy. Appreciate it. For more information, you can always reach out to us on social media or go to provincemortgage.com. Speak to one of our mortgage professionals to see what you can qualify for right now based on today's rates. Thank you, my friend. Appreciate it.